basically, with the national debt, the breakdown of the national debt into treasuries, reserves, and currency is based on the movements of those two buffer stocks of reserves and currency. In the aggregate, you can't change the quantity of reserve balances unless you change something else on the Fed's balance sheet. And so banks themselves can't get rid of the reserve balances. They can trade them back and forth to each other if the Fed has an excess out there. So the Fed can't put an excess out there and hit a target rate above zero unless it pays interest on reserves at the target rate. Okay. Let me say it again.
So if they buy up $10 trillion in bonds, putting reserves out there, what happens to those reserves?
They would sit there at 0.25%.
No, say they aren't paying interest.
They'd be at zero.
So, but then wouldn't banks still have excess reserves then?
Yes.
I'm missing something here.
Well,
okay, but
you have to change. I mean, reserve balances in the aggregate are a liability on the Fed's balance sheet.
Sure.
So from double entry accounting, unless you change something else on the Fed's balance sheet, you can't reduce the quantity of reserve balances.
No, I'm assuming they don't. Well, you have the money in the system, but there's still a liability on the Fed's balance sheet, whether they're held by the banks or whether the banks are lending them out as loans to businesses.
Right. Although the banks don't lend reserves to businesses.
No, but by virtue of having reserves, they can make more loans. By having excess reserves, they can make more loans.
No, because it's a buffer stock. So the Fed always sets a price that it will provide reserves at. So banks make loans and then go get the reserves later.
That's Fed policy. But anyhow, I don't want to.
Well, I mean that's the way every central bank does it.
Right, but central banks
because
do
it's a buffer stock.
But central banks do change their interest rate.
Oh, absolutely.
So they
absolutely.
do. They can.
But the point is for a bank, if they're going to make a loan, they don't think they can go get deposits to cover the loan on the liability side. Then they have to make a prediction of what the interest rate is going to be at that they would borrow in the money markets. So that's going to then be a higher cost to them relative to the loan that they made. The buffer stock of net financial assets, one of the reasons why I like that paradigm is because it gets us to recognize that if you stimulate through fiscal policy, it's about increasing spending with more income to the private sector, increasing their spending out of more income. If you stimulate with monetary policy, it's about increasing their spending from their same income. Okay. So if you're in a situation where you've got the private sector trying to deleverage, then using the arm of macroeconomic policy that requires spending out of existing income might not be the best way, because in fact, if monetary policy actually works right now, it'll work through the private sector increasing its leverage. Okay, and that's just accounting. That's just how it works. So if you want the private sector to deleverage and you want the economy to be stimulated at the same time, you're going to have to do it with fiscal policy, or else improvement in the trade balance. But good luck on that one. So.